Welcome back, guys. This is part 4 of the investment series for beginners on how to identify undervalued stocks and find the right valuation, and this is targeted for beginners. So we looked at return on equity in the previous video. Now we'll look at return on capital employed. So this is what your company makes from the deployed capital. The money that the company puts into the business has to earn some returns. So the entire money that the company can put in is the return on capital employed. This is for the entire company. So this has to be as higher as possible. Just like return on equity, you need to make sure whatever they deploy, they make enough out of it. So if I invest something into the business, so I would demand at least the risk-free return along with the risk premium. So this company has a risk. So I would need some amount of cushion on top of the risk-free rate. If the risk-free rate is 8%, and if I feel the risk premium is 5%, then I need 13% to be made for the business. So the return on capital employed should at least be 15% to meet my expectation. As a consumer, as an individual investor who is just starting to invest, you need to be very cautious here and make sure you don't look at stocks which produce return on capital with very meager figures. Anything less than risk-free rate is an easy disqualification. If the value is more than 14-15%, you should be happy to look at those companies. Of course, this is just one metric. We'll be looking at multiple metrics before making a final decision. So the next ratio is debt to equity ratio. How much debt do you have is very important. Debt by itself shows credit worthiness. So if you have small amount of debt, you would get tax benefits because taxation depends on your income after paying your interest. So if you pay some interest, then your final profit after interest is going to be lower and your tax rate will go down up to a certain point. If this is going to help reduce your weighted average cost of capital, so the weighted average cost of capital is a metric which tells you what is your cost on capital. If you have to go to the bank and say, I need some money, what is the interest rate they're going to charge? If you go to an equity investor and tell them, hey, I'm going to come up with an IPO, I'm going to give my shares to you, then that means they would demand some amount of returns. That is a cost for that. So that is a cost for equity investors and the banks or a debt provider. So we need to make sure the weighted average cost of capital is low. So the company might take some debt, but up to a point, it is okay to have debt. So as a beginner, I would suggest stick on to something below 0.4 and preferably don't go for anything that's more than 0.7. This way, you would be much safer in your investment journey. So if you feel you're up to the challenge of going a little higher than 0.4, then make sure you also look at the interest coverage, and if the earnings drop, if you feel that the earnings could drop below a certain level, then you need to look at the interest coverage to figure out if they can pay their installments, their obligation to the debt provider or the bank in time. To give an analogy, if you have an EMI of 10,000 rupees and if you are making 20,000 rupees today, and suppose you lose a job and your earning goes to 15,000 rupees a month from 20,000, then you should be able to pay your loan at 10,000 provided you can keep your expenses at 5,000 rupees. Suppose your income drops to 5,000 rupees and your loan requirement every month is 10,000 rupees, then you will be having an issue. So make sure that doesn't happen to your company, but to avoid that, keep your debt lower than 0.4. In that way, you don't need to worry about all the other ratios that you need to look at and historic and future predictions that you need to make sure that the company does not have a liquidation issue. So to avoid all these, as a beginner, I advise you to be cautious. So again, to remind you, this is a multi-part series. We have multiple parts, and this is on equity ratios, and this is going to be a continuation of multiple videos. So make sure you watch videos before this and after this, and you don't forget